Today, we are going to discuss why shockingly high proportion of large cap mutual funds tend to underperform their benchmarks and what should investors do about it. We looked at the data ending March 22 and found that 82%, 75% and 93% of large cap mutual funds trailed their benchmarks on 1, 3 and 5 year basis. Why does it happen? Short answer, fund managers tend to fall prey to the tyranny of benchmarks. If you look at the benchmarks for large cap funds or large cap oriented funds, they tend to be very top heavy. Let's look at NSE 100, which is a very popular benchmark for large cap schemes. Top 10 stocks, that's 10% of the constituents, account for 50% of the total benchmark weight. This creates dilemma in the minds of the fund managers to own or not to own low conviction heavyweight stocks. Driven by the fear of underperformance, often fund managers tend to take neutral or underweight positions in these low conviction heavyweight stocks. Unfortunately, this results in a lot of capital getting locked in defensive positions, leaving very little to take active positive bets to generate alpha. Unfortunately, this suboptimal allocation driven by the fear of underperformance leads to exactly the same outcome. So what should investors do about it? Option 1, might as well invest in ETFs or index funds. At least you will replicate the benchmark performance. Or the other option is invest in genuinely benchmark agnostic active strategies so that you at least have a shot at outperforming the benchmark. Thank you.